Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, August the 14th, 2025, recording this in the morning. Okay, so what we do have today is a little bit of an update on the data in terms of the US. And the market's going to be very, very interested to look at the PPI because keep in mind, as we all know, that we had the CPI. Which came in the other day, and I thought that it was at most you could say was kind of neutral, but even slightly sort of warmer than what the Fed would have liked. Because looking at all the numbers, in my personal opinion, it certainly doesn't indicate that inflation is moderating in any shape or form. Nonetheless, the market interpreted that as being in line and therefore acceptable enough for the Fed to continue, to begin a cutting cycle starting possibly in September. Anyway, we'll get an update on the PPI. So that's the producer price index. So that's the sort of the input prices. And of course, a lot of the PPI feeds into some of the core elements in the PCE, which we're getting, I believe, next week. I think it is. I have to double check that, which of course is what the Fed apparently that's their main sort of gauge of inflation, or the most important one. They look at many of them. So let's keep an eye and see what happens. If this does confirm that inflation is not sort of unacceptably high, that should lead to maybe sort of strength in gold, strength in the front end of the curve, so the yield could go down. We might get more of a bull sort of steepening as well. Could have some continuing weakness in the US dollars, and I think equities would probably enjoy any kind of confirmation in the inflation data, which essentially would give the Fed the green light to start cutting in September. But on the other hand, if this contradicts the CPI, and so the ones we need to be looking out for is, let's say, the month-over-month numbers, the excluding food and energy month-over-month expected to come in a little bit hotter than last time at 0.2. So we need to be looking out at these, final demand month-over-month. If these numbers come in hotter and significantly contradict the PPI, that could cause a bit of an unwind in a lot of that, a lot of those moves which we saw the other day. Let's just have a look at that. So if you look at this is a pricing for December, as you can see, we're now at about 63 basis points of cuts being priced in by December. And you can see here that even for September, we now have over 25 basis points. So a full cut, 1.02 cuts are priced in. So a full cut priced in for September. Then also we have not exactly a second cut by October, but basically between 2.5 cuts priced in for the end of the year. So this is going to be interesting today with this PPI data, because if this, as I say, comes in on the hot side, then that's going to give a lot of this stuff is going to be unwound sort of hawkishly. So the front end yields should probably come back, sort of go up about 4, 5, 6 basis points. And basically September, I mean, maybe it's not going to go down a massive amount, but instead of being 25 basis points, that could go down to, let's say, 20 basis points. And I think the pricing for October could also sort of diminish. And so by the end of the year, pricing of 2.5 cuts or 62 basis points, I think we could lose, easily 4, 5, 6 basis points, just to sort of hawkishly reprice that into, maybe 2 cuts by the end of the year rather than 2.5. So, but having said all that, it does depend on all the data. And of course, we also get initial jobless claims. We like to look at the 4-week moving average just to smooth it out a little bit, and the continuing claims. So if we look at what's expected, 225,000, you see that's very similar to last time. And if we actually look at that, let's just look at the moving average here. Let's put this on a price. So if you look at the moving average, I mean, this is a number which goes up and down, but by any sort of stretch of the imagination, if we kind of scroll out here a little bit, you can see that essentially the 4-week moving average here on the initial jobless claims is anything from 220,000 to 30,000. But the reality is that for a recession or a severe weakening, we'd really have to see that on a regular basis being up into, let's say, 260, 270, 280, 290, 300,000 to really indicate that companies are actually getting rid of workers. And it seems to be at the moment, and this is being echoed by a lot of Fed speakers, is that companies are not exactly booming and hiring people and employing new people, but on the other hand, they're not actually firing people either. And so we're getting this sort of situation where the labor market, even if it's not really expanding, it's not really contracting, and it seems to be in some kind of period of stability. And keeping in mind as well that the number of undocumented immigrants coming to the US is massively down. I was looking at some numbers yesterday. It's almost like it's I don't want to say it's a zero, but it's massively down since Trump's come to power, and that also means that there aren't a lot of new workers coming into the labor market, and that's possibly also giving companies pause before firing people, for lower wage workers or something like that. Just like the situation has come and stable. So at this point, in my view, there's no evidence that the labor market, in terms of the initial jobless claims, is causing particular problems. We also have the continuing claims, which is expected to be or 1.96 million. And again, let's just look at that from with a little bit of perspective here. We'll put that on a price graph. Let's see, it's coming up. Yeah, so this is the one which is interesting, and this gives the pessimists a little bit of sort of some ammunition, so to speak, because what we are seeing here is that the initial jobless claims is fairly steady, as I just said, 220, 230,000 per week. But what does seem to be worsening, and is maybe the canary in the coal mine and a warning sign, is that the continuing claims, as you can see here, is starting to head up. So we had 1.85 million up to 1.9 million, 1.95 million. As you can see here on this chart, which is sort of a weekly numbers, it definitely seems that in the last 2 to 3 or 4 months, something is happening. And the continuing claims, of course, are people who have been on unemployment benefits, not for the first time, which is initial claims, but people who are finding it harder to actually transition to a new job, and they are continuing to claim benefits after a multi-week kind of time frame. So is this indicating that it's actually harder if you do lose your job, it's actually harder to find another job? And that, of course, could be indicating that the labor market structurally is weakening. And keep in mind, we had those huge revisions at the last non-farm payroll. So this is definitely an interesting number. And I would say that the market is possibly even looking at this one with greater attention than the initial jobless claims. So let's definitely have a look at all of that stuff put together. So again, what would be what the Fed wants to see is a PPI which is stable or maybe even a little bit lower than expectations, and an initial jobless claims. Well, the Fed probably wants to see that sort of strong. But certainly if we get a soft or inline PPI with a weakening sort of labor statistics here, for sure, gold would like that. US dollar would weaken, the front end of the curve. So the 2 years would love that. Maybe even the back end is a little bit, but certainly a lot more on the front end. In terms of the equities probably the perfect solution or result, or Goldilocks, would be an initial jobless claims, which was fractionally weaker. So just giving the Fed the green light, but not too weak. The equity market probably doesn't want to see, an economy which is collapsing. The equity market in general wants to see an economy which is not too hot, not too cold, and will enable the Fed to potentially to cut in September. So anyway, so we'll get a view of all of that. Now, in other news, apart from my tea, some nice Earl Grey this morning with some bergamot in it. Okay, so what was another interesting thing is that we had comments yesterday from Bessent, Treasury Secretary. Now, apart from the fact that he was calling for the Fed he's saying that interest rates should be, 1.5 to 1.75% lower than where they are at the moment. He said all kinds of models point us that direction. But to be honest, if you look at something like the Taylor rule or a bunch of other sort of econometric models, a lot of them actually say that the Fed shouldn't be cutting. If anything, with inflation, in the high twos, early threes, depending on the metric, if anything, the Fed maybe should even be hiking interest rates. So I don't know where Bessent got his modeling from. But anyway, but so apart from that, still maintaining the political pressure on the Fed to cut. But what was also interesting is that he said that Japan seemed to have an inflation problem, and that he expected that the Bank of Japan would be hiking interest rates sometime soon. I don't think he said they should hike. I think he said that he expects them to be hiking. So although it's the US Treasury Secretary, obviously he's an important person in the markets. And it's interesting, the reaction has been not only yesterday, but over the last couple of days, we're seeing this is the 10-year yield in the JGB, so the Japanese government bonds. And you can see on a 15-minute chart. And you can see here over the last couple of trading sessions, but especially yesterday, a lot of people are attributing this to Bessent's comments. You can see those Japanese yields starting to push up a little bit higher on the expectation. Well, maybe not the expectation, but at least on the political pressure or the commentary coming from the US Secretary of the Treasury. So with that sort of rise in yields, we're also seeing a concomitant. It's interesting to look at the differentials over in the US here, because what I've got here is just going to bring up the differentials here between the US 10-year subtracting the Japanese 10-year. This is the differential on the 10 years. And what we can see here is that on one hand, you've got the possibility that the Bank of Japan sooner rather than later will be hiking interest rates, which is pushing up those yields. And of course, in the US, especially at the front end, but all across the curve, you do have a little bit of sort of downward pressure on the yields, especially a lot of political pressure, and especially at the front to the belly of the curve, but also, at the back of the curve is not immune to that. And what you can see here is just how the yield differential in the last couple of days is also coming in between the US. So it was at about 280 basis points or so, now down to 265. So there's quite a substantial move there, 15 basis points of contraction in the yields. And that's being reflected, we're starting to see that being reflected a little bit in the strength in the Japanese yen. So if we look at let's look at some of these cross pairs quickly. So if you look at the Aussie versus the Japanese yen, you see yesterday on the back of those comments by Vicent, pretty substantial move down in Aussie JPY. So JPY showing strength here against the pound. You see the pound down, and importantly the euro versus the JPY, same kind of thing. And then so in all the crosses, the Japanese yen showing quite a lot of strength. So if we go up to the US, you can also see in the US dollar the US dollar weakening yesterday against the Japanese yen. So is this going to continue? Interestingly enough, if we look here, it's quite an interesting level here for the USD JPY, because we are at here the 20 and the 50-day moving average and the 100-day moving average. So they're kind of a bit of a congruence here, a confluence, I should say, a confluence of all these moving averages. So quite a key point. This is also just from this most recent impulse up. This is like a Fibonacci level here, which is just on the 38% towards the 50. So quite an interesting point here. I mean, you can start drawing trend lines. I don't know if that's a trend line or this is a trend line. It's not perfect because you have this little break here. But basically, it's something to keep an eye on is the yields in the Japanese government bonds, and also especially the differentials, and maybe even more at the front of the curve, something like the US 2-year subtracting the Japanese 2-year. Let's keep an eye on that, because if that continues to narrow, and we still get that political rhetoric, to try and push down US yields and maybe push up Japanese yields, and maybe that's what Besant was trying to do here, is really trying to weaken the US dollar against the Japanese dollar in terms of helping the trade situation. So that's something interesting to be looking out for. Okay. Apart from that, we do have the Trump meeting Putin tomorrow in Alaska, I believe at 11:30 a.m. Trump is starting to downplay that and saying, well, it's kind of a listening tour. He wants to hear what Putin has to say. So I personally don't know that we're going to have any sort of dramatic, there's a sudden ceasefire, because obviously, as we know, Zelensky of Ukraine and the Europeans are not at that meeting. So let's see. I mean, let's keep an open mind. You never know. Maybe Putin will spring something, and maybe Trump will spring something. But anyway, the oil market is watching that, because if there is some sort of positive sentiment, any signs of a ceasefire, that's going to be interpreted by the oil market as meaning, definitely less sanctions on Russian exports of crude oil. So that could be a positive, I suppose, for the oil market. Or let's just keep an eye on that. But just in terms of the oil market, we do have, continuing sort of a negative price pressure. As you can see, as I was saying yesterday, we've blown through those stops. We're down all the moving averages here. So this is a weak market. At this point, we'd have to, let's see what happens with as I say, the Putin Trump meeting. And another way to interpret that as well is that if there are going to be less sanctions, presumably that could also free up some exports and extra volume on the free market, on the open market of Russian oil, which potentially, I don't know, to me that sounds like potentially a negative, not necessarily a positive. So what actually could be a positive here would actually be the opposite, would be if the meeting ends poorly with no sign of a ceasefire, maybe even, a negative rhetoric, and Trump comes out and starts talking about the need to be tougher with Putin and impose sanctions and block the oil exports. So that could actually be a supportive for the oil price. But at this point, pretty weak price action, although you have to say it is running out of energy here. So we could get to some kind of basing formation at some point there, not a huge amount of energy. Another thing just to keep an eye on is just looking at the stocks yesterday. So if we look at something like the S&P 500, it is still grinding higher, but not a huge amount of energy. Still a very bullish chart. Similar kind of situation with the Nasdaq, just having a little pause over the last couple of days. But what we have seen It's just a huge ramp up in the Russell. So the small caps, you see the Russell ripping much, much higher and outperforming both NASDAQ and the S&P 500 yesterday. And the other interesting thing to look at is just the comparison here. So let's look at the Mag 7s. So you see the Mag 7s, the tech, which of course obviously is the big component of the NASDAQ. But you see the Mag 7 ETF here actually having a little bit of a negative day yesterday, although again, still a very positive chart. But look at the equal weight. So we see the equal weight ETF RSP, that's up towards sort of the highs, the recent highs here. So definitely a whole sort of rotation. So, a lot of analysts, I was reading some commentary sort of overnight and this morning, people are saying there's two ways of looking at this to say this is a bit of a short squeeze and that everyone was actually long tech, short Russell or long tech, short, sort of small caps. And this is more sort of a technical short squeeze, people having to, get, sort of buy back their shorts. Rather than some sort of wonderful rotation into a small cap and equal weight. We'll see. But on the other hand, let's be honest. It looks as though the Fed potentially could be cutting in September. Lower interest rates are often seen as being a positive for domestic sort of companies or, like smaller companies. We'll see. But that's definitely something interesting to look at here and try and figure out what's going on under the hood in terms of a rotation. Apart from that, not a huge amount to I have more to say. VIX remains low. As I said, if you look at also volatility in the bond market on the MOVE index, that remains low. So, the market is relatively sleepy here at this point. If we go over to Europe, we let me find the Euro Stoxx 600, which is here. You can see that continues to grind higher. So that's maybe on the back of just a certain calmness maybe in sort of trade relations and whatnot, because I don't know how positive this should be, because it's just interesting. This morning we got a Eurozone industrial production just a couple of hours ago, and just looking at the numbers here, the year over year came in at 0.2, expected 1.7. And last month, the year-over-year number was in the threes. So a massive deacceleration there in the year-over-year industrial production for Europe. And if you look at the month-over-month number, that was negative. So negative 1.3%, again, lower than expectations of -1%. So bottom line, industrial production in Europe had a pretty nasty slowdown in the most recent numbers. So although the equity market here is pushing higher, the bigger picture is just how strong is this European sort of industrial base? Let's keep an eye on some of those numbers as we go forward. Okay, guys, I'm going to leave it there. So let's keep an eye on the data at 8:30 and in the lead up to the Trump-Putin sort of meeting tomorrow. No doubt Trump will be sort of and the Kremlin will be putting out their spin on things. Okay, thanks very much. Have a great day, and I'll keep this going tomorrow. Bye.